did Peter Lynch turn an $18 million investment into a $14 billion success? And what critical insights from his methods can you apply to achieve your financial success? Who is Peter Lynch? Peter Lynch is a legendary figure in the investment world. During his tenure at the Magellan Fund, Lynch achieved unprecedented success, averaging an annual return of 29.2% over 13 years. Under his management, the fund grew from $80 million to a staggering $14 billion in assets. Lynch's investment philosophy, which emphasized thorough research and a focus on companies with strong fundamentals, resonated with many investors. He famously encouraged retail investors to leverage their everyday experiences to identify promising stocks, making investing more accessible and relatable. Investment philosophy. Peter Lynch's investment philosophy is built on a foundation of practical wisdom and a deep understanding of the market. One of his core principles is the concept of invest in what you know. Lynch believes that individual investors have a unique advantage because they can identify promising companies based on their personal experiences and insights. By focusing on industries and businesses they understand, investors can make more informed decisions and spot opportunities that others might overlook. Thorough research and analysis are also central to Lynch's approach. He advocated for digging deep into a company's fundamentals, including its earnings, growth potential, and competitive position. Lynch often emphasized the importance of understanding a company's story, which involves looking beyond the numbers to grasp what makes a business thrive. This diligent research helps investors make sound decisions and avoid pitfalls. Additionally, Lynch introduced the idea of growth versus value investing. While growth investing focuses on companies expected to grow at an above-average rate, value investing seeks undervalued stocks that have strong fundamentals. Lynch believed that both strategies could be effective, depending on market conditions and individual investor goals. By blending these approaches, investors can create a diversified portfolio that balances risk and reward, ultimately leading to long-term success in the stock market. If you're enjoying the video, hit the subscribe button and comment down your thoughts. If you want to explore money-making strategies, click the link in the description to start your financial journey. The Magellan Fund success. Under Peter Lynch's management, the Fidelity Magellan Fund achieved remarkable performance that set a new standard in the investment world. From 1977 to 1990, the fund delivered an astonishing annualized return of 29.2%, significantly outperforming the S&P 500 during that period. At the start of Lynch's tenure, the fund had just $80 million in assets, but by the time he stepped down, he had grown to over $40 billion, making it one of the largest mutual funds in the world. Several key investments played a crucial role in the fund's success. Lynch famously invested in companies like Ford and Dunkin' Donuts, recognizing the potential for growth long before they became household names. His ability to identify emerging trends and capitalize on them was a hallmark of his investment strategy. For instance, his early investments in the retail sector, particularly in companies like The Gap, showcased his knack of spotting consumer preferences before they became mainstream. Market conditions also influenced the fund's performance. During the 1980s, the US economy experienced significant growth, which provided a favorable backdrop for Lynch's investment strategies. However, Lynch's disciplined approach to research and his focus on long-term value allowed the Magellan Fund to navigate market fluctuations effectively, solidifying his legacy as one of the greatest investors of all time. Common mistakes to avoid. Investing can be a rewarding journey, but it's also fraught with pitfalls that can derail even the most seasoned investors. One of the most significant mistakes, as highlighted by Peter Lynch's experiences, is emotional investing. When investors let their emotions dictate their decisions. They often make impulsive choices that can lead to significant losses. Panic selling during market downturns or chasing after stocks that are soaring can result in missed opportunities and financial setbacks. Lynch emphasized the importance of maintaining a rational mindset and sticking to a well-thought-out investment strategy. Another common pitfall is following trends without conducting thorough research. Many investors are tempted to jump on the latest hot stock or sector, believing that they can ride the wave of popularity. However, Lynch warned that this approach can be dangerous. Without understanding the underlying fundamentals of a company, investors risk losing money when the trend inevitably shifts. Conducting diligent research is essential to making informed decisions. Also, patience and long-term thinking are crucial in investing. Lynch often stressed that successful investing is not about quick gains but rather about holding on to quality investments over time. Many investors become impatient, seeking immediate results and abandoning their strategies too soon. By cultivating patience and focusing on long-term growth, investors can better navigate the ups and downs of the markets, ultimately achieving their financial goals. Real-life investment stories. Peter Lynch's investment journey is filled with anecdotes that offer valuable lessons for investors. One of his most notable successes was his investment in Dunkin' Donuts. Lynch recognized the brand's potential early on, understanding that the growing healthy culture in America would drive demand for its products. His rationale was simple. He saw people lining up for coffee every morning, which indicated a strong customer base. This investment not only yielded significant returns but also underscored Lynch's principle of invest in what you know. By observing consumer behavior, he was able to identify a winning company. However, Lynch also faced his share of mistakes. One such misstep involved his investment in a technology company that he believed was on the verge of a breakthrough. Unfortunately, the company failed to deliver on its promises, leading to substantial losses. This experience taught Lynch the importance of thorough research and the need to remain skeptical, even when a company appears promising. He learned that hype does not always equate to success. These stories connect to broader investment principles, emphasizing the importance of understanding market trends, conducting diligent research, and learning from both successes and failures. Lynch's journey illustrates that investing is not just about numbers. It's about recognizing patterns, being patient, and continuously evolving as an investor. Key takeaways. Peter Lynch's investment approach offers invaluable lessons that can guide both novice and experienced investors. One of the most essential takeaways is the importance of understanding your investments. Lynch famously advocated for investing in what you know, emphasizing that familiarity with the company or industry can lead to more informed decisions. By taking the time to research and comprehend the businesses behind the stocks, investors can better navigate the complexities of the market. Another critical lesson is the need for a disciplined investment strategy. Lynch's success was not merely a result of luck. It stemmed from a consistent approach to analyzing stocks and maintaining a long-term perspective. He encouraged investors to stick to their strategies even during market fluctuations, and to avoid emotional decision-making. This discipline can help investors weather the inevitable ups and downs of the market. Thirdly, the value of continuous learning in investing cannot be overstated. Lynch believed that the investment landscape is always evolving, and staying informed is crucial for success. By reading books, following market trends, and learning from both successes and failures, investors can refine their strategies and improve their decision-making skills. Embracing these key takeaways from Peter Lynch's investment philosophy can empower individuals to achieve their financial goals and build a successful investment portfolio. Thanks for watching, and we will see you in the next video.